Welcome back to the Financial Knowledge Group. In this video, we'll explore the top performing stocks from mid-2020 to mid-2025, their growth stories, and what these explosive gains mean for investors like you. Some surged over 2,000%. First up, GameStop. Once a struggling video game retailer, it became the face of the meme stock phenomenon. In just a few months in early 2021, it went from a few dollars to hundreds, fueled by Reddit traders and social media hype. Since 2020, the stock returned more than 2,400%. Next is Celsius Holdings, a performance energy drink company. Its explosive marketing, influencer partnerships, and major retail expansion drove exponential revenue growth. Celsius stock gained around 2,400% over the last 5 years. Coming in third, Enphase Energy, a solar technology company that makes microinverters for residential solar systems. As the clean energy trend gained momentum, Enphase saw massive revenue growth and profitability. Its stock soared over 2,300%. Then we have Tesla. While it was already a household name in 2020, Tesla's continued dominance in electric vehicles, innovation in AI and self-driving, and soaring deliveries pushed its stock up around 1,300% during this period. Finally, Supermicro Computer, or SMCI, a lesser-known player that became a powerhouse in the server and data center space. As AI and cloud computing boomed, demand for SMCI's high-performance servers exploded. Its stock gained around 1,200% in just 5 years. These 5 stocks crushed the market, delivering life-changing returns for early investors. So, what drove this kind of massive growth? 3 key factors stand out. First, real business expansion. These companies didn't just go up on hype. Most of them saw huge increases in revenue, product adoption, and market share. Second, powerful macro trends. Whether it was clean energy, electric vehicles, health and wellness, or artificial intelligence, each of these stocks aligned with broader societal shifts. Third, investor sentiment. In some cases, like GameStop, it wasn't fundamentals but the power of collective momentum, internet communities, and short squeezes that propelled the stock upward. When business performance meets hype and timing, the results can be extraordinary. Let's take a quick look at how these companies are doing today. As of mid-2025, Tesla trades around $300 per share and remains one of the most valuable companies in the world. It continues to lead in EVs, battery tech, and AI integration. Celsius Holdings is now in major grocery chains and global markets. Their branding has turned them into a serious competitor to Red Bull and Monster. Enphase continues expanding internationally as residential solar adoption rises. GameStop, on the other hand, has pulled back significantly from its meme stock highs. While it still has a strong brand, it's no longer trading anywhere near peak levels. SMCI remains one of the biggest beneficiaries of the AI boom, selling high-performance server systems used in data centers powering generative AI. All these stocks reflect a mix of hype, innovation, and actual business results. What separates sustainable winners from temporary hype? Many experts point to 3 numbers: growth in revenue per share, R&D investment, and profitability. Companies that continually grow their top line while reinvesting in innovation tend to outperform over the long term. Tesla and Enphase consistently reinvested in technology and capacity. Celsius kept expanding its brand reach. SMCI capitalized on a sudden surge in demand, but did so with strategic partnerships and smart inventory control. Meanwhile, stocks like GameStop remind us that sometimes sentiment can take a stock far beyond its fundamentals, but it rarely stays there forever. The lesson: growth needs to be supported by substance. It's tempting to chase high-return stocks, but it's critical to understand the risks. First, volatility. stocks that rise 1000% can fall 80% just as fast. Many of the top performers experienced wild swings along the way. Second, sustainability. Not all growth is permanent. Trends change, management shifts, competitors emerge. Third, valuation risk. If a company is priced for perfection, even minor setbacks can crush the stock price. Overpaying, even for great businesses, is a common mistake. Finally, survivorship bias. For every Celsius, there are dozens of companies that never made it. So looking only at the winners can give a distorted view of the real odds. So, what should investors take away from this? Yes, it's possible to achieve massive gains, but it's rarely predictable and even harder to repeat. The most successful long-term investors focus on companies with strong fundamentals, competitive advantages, and clear paths to growth. They also diversify and avoid emotional decisions. Rather than hunting for the next meme stock or 10-bagger, look for consistent performers in industries with secular tailwinds, like AI, renewable energy, cloud computing, and health tech. Being early helps, but staying invested in quality businesses is often even more important. In the last 5 years, we've seen an incredible market run, full of surprises, spectacular gains, and a few cautionary tales. GameStop, Tesla, Celsius, Enphase, SMCI, each tells a different story. Some based on hype, others on innovation. The next 5 years will bring new opportunities. The key is to stay informed, stay patient, and stay focused on fundamentals. If you found this video helpful, make sure to like, subscribe, and hit the bell icon so you don't miss future investing insights. Thanks for watching, and here's to smart investing.